Hey everyone, welcome back to Corporate Decoder. Today, Popular Inc. just filed its Q2 2026 earnings report, and I'm seeing some really interesting trends in their loan portfolios that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just boosted its dividend and announced a huge share buyback. But we need to look under the hood at the details. Let us dive right into Popular Inc.'s latest quarterly report. They are a big financial holding company with operations in Puerto Rico, the US mainland, and the Virgin Islands. This filing gives us a snapshot of their financial health as of the 30th of June 2026. Looking at their balance sheet, total assets climbed to just under $79 billion, up from about $75 billion at the end of last year. That growth is largely coming from their investment securities, especially available for sale ones, which went up by a significant $4.2 billion. They are investing more in US Treasury securities, which is generally a safe bet, especially when yields are attractive. On the flip side, their loans held in portfolio also grew, which is a good sign for a bank, but it also means they are taking on more risk. Total loans held in portfolio net of all the adjustments reached nearly $39 billion. That is an increase of about $422 million since the end of 2025. This growth is spread across their main operations in Puerto Rico and the US mainland, showing they are expanding their core lending business. Now, a critical number for any bank is the allowance for credit losses, or ACL. This is the money they set aside to cover potential loan defaults. For loans held in portfolio, the allowance is about $785 million, which is a slight decrease from the end of last year. This usually means they are seeing some improvements in credit quality or their economic outlook has improved. But we need to dig deeper. The ratio of this allowance to their total loans is just under 2%, which is still pretty healthy. When we look at loan delinquencies, things are mostly stable for BPPR, their main subsidiary in Puerto Rico. The total past due loans are around $1.1 billion. For Popular US, it is about $83 million. What is interesting is the breakdown. In BPPR, a big chunk of that past due amount is in their mortgage portfolio, with over $320 million past due 90 days or more. Popular US also has a significant portion in commercial real estate, particularly non-owner occupied properties. The company reports around $367 million in non-accrual loans for BPPR, meaning these loans are not earning interest. That is a decrease from the end of last year, which is a positive sign. The biggest chunk of these non-accruing loans is in their commercial and industrial portfolio, followed by commercial real estate. For Popular US, non-accruing loans are much lower, around $45 million. This increased provision for credit losses is worth noting. For the quarter, it jumped to $65.9 million, up from about $49 million in the same quarter last year. This increase is mainly driven by higher specific reserves in BPPR's commercial loan portfolio, particularly for a large non-performing loan that was transferred to loans held for sale, resulting in a significant charge-off. They also added reserves for two other commercial and industrial relationships that became non-performing. While some consumer loan provisions decreased, these commercial issues are a key reason for the overall increase in the provision. This signals some specific headwinds in their commercial lending, especially in Puerto Rico, moving to non-interest income, which is basically fees and other income sources. It came in at $180.5 million for the quarter, up from $168.5 million last year. A big driver here is higher credit and debit card fees, which suggests more customer activity and spending, especially with their new corporate-focused credit card products. That is a positive sign for their fee-generating business. Operating expenses actually decreased slightly to $484.1 million compared to last year's quarter. This is good to see, especially with increased investment in technology and software, which grew by about $6.3 million. The decrease is mainly due to lower operational loss reserves and professional services. It looks like they are managing costs well, while still investing in the future. All of this led to a net income of $278.2 million for the quarter, a healthy increase from $210.4 million in the same quarter. Last year, this higher net income is a combination of better net interest income, increased non-interest income, and controlled operating expenses, even with that higher provision for credit losses. Looking at stockholders' equity, it grew to $6.4 billion from $6.2 billion at the end of last year. This is a good sign, showing the company is building its equity base. Notably, their tangible common book value per S-share also increased, which is a metric that excludes goodwill and other intangible assets, giving a clearer picture of the core equity value. Capitalization ratios remain strong. Their common equity tier 1 capital ratio is over 16%, well above the regulatory minimums, showing they are in a solid financial position to weather potential downturns. They also announced a dividend increase and a massive $1 billion stock buyback authorization. This signals confidence from management in their future performance and a desire to return capital to shareholders. On the compensation front, they continue to grant stock awards to management and directors. These are important for aligning executive interests with shareholders, but they also represent a cost. For management, they have over $186 million in non-vested restricted stock and performance shares expected to be recognized over the next year and a half. When it comes to fair value measurements, Popular Inc. is dealing with a lot of level 2 and level 3 assets. This means a good chunk of their investments are valued using models and unobservable inputs, not just direct market prices. Their mortgage-backed securities, for example, have significant unrealized losses driven by interest rate changes. While these are available for sale, it highlights the sensitivity of their portfolio to market fluctuations. Delving into the loan portfolio, commercial real estate loans, particularly non-owner occupied, are worth watching. While the overall loan portfolio is growing, specific segments like commercial real estate are showing some stress in their delinquency figures. Their exposure to Puerto Rico government entities is also substantial, and any fiscal instability there directly impacts the company. They have over $400 million in outstanding loans and investments with Puerto Rico municipalities, and while some are rated, others are not, adding to the risk. Let's touch on net interest income, which is the difference between what they earn on loans and investments and what they pay on deposits and borrowings. For the quarter, it increased significantly to $693.4 million. This is a solid jump, mainly thanks to higher yields on their US Treasury securities and loan growth, combined with lower deposit costs. Even though they had to set aside more for potential loan losses, the higher net interest income more than compensated for it. Their net interest margin, a key profitability metric for banks, also improved. Now, that increased provision for credit losses is a big story here. While some consumer portfolios are showing improvement, the commercial loan portfolio in Puerto Rico is facing some specific headwinds. The charge-off of that large non-performing loan and the new non. Performing loans in the commercial and industrial sector are putting pressure on their loan loss reserves. This is something to keep a close eye on, especially given the concentration of their business in Puerto Rico. Scronin Performing Assets (CVG), the overall non-performing assets figure is relatively stable. But the increase in commercial NPLs is notable. The resolution of that large commercial relationship is a positive step, but the new inflows are a concern. Their CRE portfolio, especially office space leasing, is a small part of their overall loans, but it is something to monitor given the current market conditions. Their exposure to Puerto Rico's government and municipalities is a recurring theme. While some of it is secured, any further fiscal deterioration in Puerto Rico could put pressure on these assets. The ongoing legal challenges around the Oversight Board are also a point of uncertainty for the region's economic stability. So, what is the big picture here? Popular Inc. is showing solid growth in net interest income and non-interest income, managing expenses well, and maintaining strong capital ratios. However, the rising provision for credit losses, particularly in their commercial portfolio in Puerto Rico, is a significant risk factor. The company is navigating a complex economic landscape, especially in Puerto Rico, and while they are making strategic moves like increasing dividends and buybacks, the credit quality of their loan book, particularly commercial loans, warrants close attention. The risk I am watching is how those commercial loan issues in Puerto Rico develop and whether they spread. The biggest concern is any systemic risk tied to Puerto Rico's fiscal health. What I'm actually looking for is continued strong management of their loan loss provisions and sustained growth in fee income to offset potential credit headwinds. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.